Hello, everyone. Welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets, and I'm based in London, UK. Also in the room is my colleague Victor, who's joining us from Bulgaria. So today's webinar is about technical analysis of major indices, commodities, and FX pairs. But be advised that this week is the fourth quarter US earnings that will dominate the agenda, and we have a few big technology companies reporting in the next few days. So it's really important to pay attention to those.
As if earnings are driving the market.
What is driving the markets, Victor?
Utter and exceptional craziness.
Yeah. That's how you can describe this this crazy bull run, right? If you think about we are in the middle of a pandemic. Not many companies are making a profit, yet their stock prices are going absolutely crazy. There was a particular stock doing the runs yesterday. Was it called GameStop or something?
GameStop, yes.
Yeah. That was one crazy rally. It's beyond belief.
It's a very useful company these days. It sells games.
Yeah.
It sells video games in physical stores.
Oh, right. That's it.
how much potential do you see in that? Well, it used to be trading at $5 3 months ago, if I'm not mistaken, and it was at $170 yesterday.
Oh my God, that's crazy. Anyway, let's concentrate on markets that make more sense to us, FX markets, right? It's been very quiet actually in the last couple of weeks. Ranges have dominated. The dollar has rebounded.
It's different without Trump.
Absolutely. We do miss him for the markets and for his tweets, but nothing more than that, I don't think. Without getting too political in this. Anyway, let's crack on, okay? So before we proceed, it's important to be aware of the risks involved when trading, and please take a few moments to read through the disclaimer. So I'm going to help you with reading the first paragraph, and then we'll move on to the live charts. Okay, so these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So it's a half-an-hour webinar, and we concentrate, as I mentioned, on major currency pairs, gold and indices. We do touch on fundamentals very briefly, and as always, we take questions. So please provide any questions you have during any time in this webinar, and we'll be more than happy to answer any questions that you have. So let me just exit this and go straight to the charts. And shall we start with the FX markets, Victor? Because it's
sure.
So the dollar index has rebounded in recent days. Hasn't gone really anywhere fast, which suggests to me that the dollar bears are not the dollar bears are still out there, hunting for a
certainly. There is a consolidation phase, and we don't see much moves really. We're in this very tight range between 90 and 91, almost for the whole month really.
So in an environment like this, how do you trade FX? And one of the ways I would trade it is because the market is not going fast. You get lots of sideways price action. So I think reducing the position size is one thing, because you don't want to continually get chopped, and that will allow you to have a wider stop loss order in place, which means that you can remain in a trade or potentially could remain in a trade longer than you would in a normal scenario. But because the markets are not moving, it also means that the potential reward is probably lower than you would get from a fast-moving market. So it's really difficult to trade in this market environment. So best thing to do is pick your trades really carefully and trade as close to the level where you think your analysis is wrong. So entry could be, for example, if you're bearish on the dollar, try to sell it as close to resistance as possible rather than looking for breakout trades, because in range-bound markets, breakouts kind of fail sometimes, which can frustrate you and keep you in a trade and tie up your margin for a long period. So pick your levels carefully, be patient. Things will improve. It's just a matter of time. And concentrate on the markets that make more sense and is kind of showing what you would expect from a market in terms of price action. So, for example, if you think that the dollar is falling but it's not against a particular currency, forget that one. Concentrate on another currency pair that's actually showing relative movements. That said, the dollar is still inside a larger downward trend, as indicated, for example, by the falling 200-day moving average, the bearish trend line, both of which are holding above current price action, meaning that this is just, or potentially, a correction, and that the longer-term trend is bearish. So don't read too much into it until and unless we get a break above some of the key resistance levels shown on the chart. So as a starting point, if you're bullish on the dollar, as a minimum, you would want to wait for the bearish trend line to break and for the index to hold above it.
Yeah, why don't we look at some specific currency pairs?
Sure. Shall we start off by looking at the most heavily traded currency pair?
Sure.
The euro dollar. So this is my projection before, how I expected the euro dollar to go up from around 120, 121 kind of range. It hasn't really done that. It got to 123.50 at its highest before coming back down. But equally, the sell-off hasn't been too significant. We're just talking about 200 pips, if my maths is correct, just a little bit more than that, 300 pips from the high to the low. So it hasn't been a significant drop, and so far the bullish trend line is still in place, and we're holding above key support at 120. 120 was previously resistance, and it could be the next key level of support to watch in the event price comes back down to retest it. So for as long as we hold above 120 and the bullish trend line, I think overall the bias would still be to the upside. And if and when that breaks down, then at that point it may make sense to start looking for bearish setups. But Victor, you've been a bit more bearish on the euro compared to myself in the last few days, and you've been right on this. That the euro dollar has gone down, as you indicated in the last webinar and the one before that as well.
Right. So we have identified some key levels, which are currently standing in the 120.50 area, which is a smaller level where the euro bounced twice already, as we see. And the other key level is around 120, which is a psychological level, previous high that you have marked on the chart. and also coincides with this extending trend line that you have drawn from May through to November's low, just before the election.
Yeah.
So I'm looking at this from a fundamental perspective, really, and I think that however you want to look at it, the biggest risks for the dollar are currently priced in, meaning that a dramatic fiscal stimulus package is not looking very likely at this point in time. Something that would definitely cause the dollar to weaken. I think as more debt monetization on the side of the central bank will mean will translate into basically a weaker dollar. But for the time being, we're not seeing that. We don't see any likelihood of this happening, as Republicans are mounting resistance against basically this major fiscal effort by the Biden administration. And at the same time, we're seeing some cracks starting to form in the European economy. Namely, businesses are reporting close to, some businesses have reported between 30 and 40% less revenues for December. And that being a holiday season speaks volumes about what we can expect in these coming months during this widely adopted lockdowns across Europe.
Cool. Yeah, fair point.
This is the fundamental point of view.
Yeah. Yeah, no, it's always important to have that fundamental backdrop, in the back of your head when trading, because ultimately it is the fundamentals that drive the market, not the technicals. The markets move in a fundamental, because of fundamentals in a technical way, and technical analysis is really a tool you could use to look for trades, manage your trades, and so on. But unless you're trading very short term, it's you don't need to know too much about fundamentals, because if you're a trend follower and good at reading price action, you don't need to know fundamentals too much. But I think if you know both of them, that puts you in a great advantage than not knowing. So just a side point on the fundamentals there for you. Let's move on, shall we? Let's go through these currency pairs quickly. And the pound against the dollar, again, quite bullish in my view. It's still holding in that bullish channel. Every time it's dipped, it's gone back above, holding above the 21-day exponential moving average, which comes in bang in the middle of the channel. So far, it's looking good. I think it's going to get to 140 eventually. It has been a slow progress, I have to admit. But nonetheless, the path of least resistance continues to remain to the upside until or unless we take out the most recent significant low and the support trend of the bullish channel at around 134.50-ish. Okay, so that's the line in the sand for me for this pair. For as long as we hold above that, I'd be looking for bullish setups rather than bearish setups. And from here, the next upside targets are the rounds handles like 137, 138, 139. But the key level is the 140, because that level was where the pound was trading around before the 2016 referendum. And so if it gets there, we may see a reaction.
Yeah, indeed. The pair continues to slowly chop to the upside. And we're once again seeing these conditions that favor a more cautious approach for traders. If we look at the euro pound pair,
Yeah.
We have we have this still pretty key neckline around 88.65 that hasn't been convincingly broken through. We dipped below it, but then went back above it.
Yeah.
So we're still waiting for a resolution here in order to see if the British pound can break out in with a more trendy move.
Yeah. If it does start to break down below the neckline, then this could accelerate the potential rally on the pound dollar. Or if the dollar were to find support, then it could accelerate the sell-off in the euro dollar rather than the pound dollar. So watch the cross very carefully, even if you don't trade it. I mean, there's no reason why you shouldn't trade it if you trade FX markets, right? But I'm just saying, if you don't like to trade currency crosses, it's worth watching this one nonetheless. What else do we have? Should we look at a couple of commodities, currency pairs, and then move on? Okay. Let's start off with the dollar CAD. Dollar CAD is looking really interesting because it is stuck inside a strong bearish channel, bearish trend. Recently, like all the other dollar pairs, it has had staged kind of decent bounces from the lows, and recently it formed this bullish wedge, right, and bounced off of it again. So far, we haven't seen a higher high, but if it does break out of this wedge and it goes through this potential resistance around 129 to 129.50, then at that point you'd have to drop your bearish bias on the dollar CAD. So far it's looking bearish still, with the 21-day providing good resistance. So I wouldn't be surprised if this thing continues lower, but watch out for a possible breakout. So that's the dollar CAD. The Aussie dollar we haven't looked at for a while, and previously in one of our webinars, I think it was months ago, we were looking at this particular level at 72.20. We said if that level breaks, then we could see a drop. As it happened, resistance broke to the upside, the 73.40, and look how strong price continued. This was our bullish objective, the 127.2, but it's gone a lot higher than that, and reaching these Fibonacci exhaustion levels, but doesn't mean it can't continue higher. It could certainly continue higher, with this being a strong bullish trend. And one of the ways you could possibly trade this on the long side is to wait for it to break out of this wedge pattern, which we are seeing across the board in many currency pairs. So if it breaks above, that would continue to point towards high levels. If it breaks below, then at that point you could start looking for possibly short-term shorting opportunities. But the underlying trend is bullish, so I would favor, even if this breaks, we may see a few days of bearish price action, but ultimately the longer-term trend may resume, leading to fresh 2021 highs. And this is the central bullish trend line. Okay, so even if we break down from this wedge, or whatever this pattern is called, then the downside could be limited to this bullish trend line. Similar picture for the New Zealand dollar. This one is in fact looking even stronger. Let's have a look at a few yen crosses. Okay, Euro yen is amazing, because we were looking at it last time, and I was wondering whether we'll get a bounce off of this level. Look how clean this level was. Resistance, resistance, resistance. We broke above it. Price came back down, and it touched it right there, and it bounced. Very nice reaction. In addition to the horizontal support and resistance, we have the bullish trend line coming into play as well. So 125-ish is a key level of support. For as long as that level holds, the path of least resistance remains to the upside. And currently, price is testing potential resistance at around 126. Okay, and if I draw a trend connecting the most recent high, you can see that price has been inside this bull flag pattern. So this being the pole of the flag from here to here. And now it's inside a bull flag. So what you want to see now is you want to see a break above the flag to potentially pave the way for a continuation to the upside. So a flag pattern is a continuation pattern, in case you didn't know. I'm sure you knew anyway. Similar picture for the pound against the yen. Yeah, it's broken these long-term, well, this bearish trend line. A longer-term bearish trend line comes into play slightly higher. It doesn't, you know, there's no reason why it can't break that in this current market environment, which is a risk-on environment, right? So look for that to break next on the upside. Let's move on. We don't have too much time to spend on the currency market. Let's cover commodities and talk about gold very briefly. Gold has been trending sideways in the last several months, and in recent times it has had a couple of attempts to break below the 200-day moving average. But like the previous occasion in March 2020, you know, in recent months, in November and early January, we saw a couple of attempts for gold to break below the 200-day moving average, but each time it held the 200-day after a brief breakdown below it. So now what's happened is we've gone above the 200-day moving average here. Big move up. Price has now come back down to retest it from the upside. So here is where the bulls will need to step in if this thing is going to go higher. Failure to hold above 1845-ish, which is a key level of support, that would be the first bearish sign. If that level breaks on a daily closing basis, then we could see a possible breakdown back down to the long-term support at around 1800. Okay, so 1845 is key in the short-term outlook. From here, the next level of potential resistance is obviously this high here. And then if we get above that is a 1900, which was previously resistance and support. So watch the 200-day very close, very carefully. Silver is showing a similar picture. We had a very interesting candle printed a few days ago. This bullish-looking candle of the price dipped to take out liquidity below this low, and it rejected it. And then from here, price rallied and took out the high, the most recent high at 25.90. It poked its head above it, but then it went back in the range. So this is a bullish signal, and this is a possible bearish signal. So what you want to see next, if you're a bullish investor, is for silver price to go back above this 25.89, 25.90 level. Because if it does that, it would render the bearish argument void, right? So at that point, everyone that sold it based on this candle will have been trapped, right? So that level is the key level to watch on the upside. Break that, and then we are most likely to going to go possibly to 28, this high here, possibly ahead of more gains in the future. But if this low breaks at 24.35, then that would be bearish. So while it's in the middle of this range, you'll see lots of choppy price action. Maybe if you want to anticipate a bullish breakout, you know, zoom into your lower time frames and see if you can get on board ahead of the breakout, because that would allow you to add more once the breakout happens. You know, people sometimes, you know, you get lots of people telling you to wait, but the way I trade, I don't typically wait for confirmation, because if I have a strong belief about something and price is still inside a range, I try to get on board at that point, because price is at a cheaper level, right? So you get in at a better level. But also what that allows me is that once the breakout does happen, I can then move my stop loss to kind of break even or higher on the initial entry, and then I can add one more position to the like I can double my position once the breakout does happen, and that would still allow me to have an average price which is below the breakout level, which means therefore that my potential which means that the potential profit could be twice as much as it would have been the case had I waited just for the breakout. But equally, the risk is obviously twofold as well. But because I have moved my stop to break even or higher on the initial position, the risk is half. So that there's a tip for you that if you wanted to trade the way I do it and get the maximum out of it, that's how I normally do it. But yeah, anyway, carrying on to the indices, looking at the DAX first of all. DAX is one of my favorite indices. The reason for that the DAX is my favorite, one of my favorite index, stock index, is that it provides you lots of intraday ranges. It's a volatile index. Some people don't like the volatility of it, but I like it because that's what you need, right? As a trader, you need the market to move for you to make money off of it. Obviously, you want to be in the right side of the trade, right? But if you get caught on the wrong side, it could mean losses, obviously. But anyway, from the last webinar, we mentioned this bullish trend line. We say that it has broken it, so we could see the index struggle for direction, but at the same time, US indices were still pushing higher. Now, today, what we're seeing is, let me just get rid of this. We're seeing a bullish engulfing-like candle. I know this hasn't been completed yet, but this could turn into a bullish engulfing candle or a hammer-like candle, which is obviously a bullish signal. But more to the point, we have this bullish consolidation here, and it's a flag, it's a bull flag pattern, right? So when you see that, it indicates that we have seen some selling pressure, but it's mainly driven by people who have been long. They have been taking profit on their long positions rather than people actively looking for to sell the short. Because
and if you look at the monthly chart, you might see why some people might be taking profits at these levels.
Yeah, so this is the monthly right here.
Yeah, so basically we have been striving to break through the previous high, which was back in February last year.
Yeah,
and we're basically hovering around this blue line for most of this month, really.
Yeah.
And so far we haven't got a clear indication, but if we add this monthly chart to this picture, a break today, this bullish candle today, could signify a really constructive rally.
Absolutely. That's what I'm looking for as well. So you could wait. If you don't have to get in today, you could wait for the market to break this, and then you could look to go long on the rounded retest of the resistance trend of the bull flag. Obviously, by waiting too long, you'll have to be careful where you place your stop loss, but that's a topic for another day. But from a technical point of view, price is working off its overbought conditions through time rather than price action. What do I mean by that? If you put an indicator on this chart, a relative strength index, which is a momentum indicator, right? And you can see that right here, the RSI was at, let me just make this big. The RSI was at 70 or above, which indicates the market was overbought right here. And when the market gets overbought, it can work off its overbought conditions by doing two things. First, through price action, which means a sell-off. So if the market sells off, you'll see the RSI indicator go down. Or it could just consolidate, which is the case here. And when it consolidates, the RSI indicator starts to go down because this is derived from moving averages. And so it goes down if price is stable. It doesn't have to fall. So in this case, the RSI has gone down, working off its overbought conditions through time, which therefore means that people who are trend followers, they will see this and think, okay, the market is no longer overbought and we've got a bullish signal. It's time to go long again. So this is a very strong bull signal in my view.
Yeah, because, it looks that way. Yeah. Today's candle is very constructive, and
absolutely.
We might see a very swift move to the upside over the coming days.
Yeah. So that's the German DAX for you, and you can see a similar picture across the board in Europe. I'm not going to waste too much of your time, but one particular index is the FTSE 100. Yeah, FTSE is looking really constructive. Also, from a fundamental point of view, we've seen this trend of growth stocks, value stocks outperforming in recent times because of expectations that the development of the vaccines could see the economy rebound strongly, and investors have been piling into value stocks that tend to perform well during economic during times when the economy is growing or expected to grow. And so the FTSE has plenty of those stocks, or the UK 100. And, that's why the index has been rallying rapidly since November, outperforming some of the European indices. Most recently, it broke out above this resistance area. Then it went into a period of consolidation inside this bull flag pattern. Now it's looking like it wants to break out to the upside again. So watch out for that potential breakout on the FTSE 100. Let's go and look at, actually, let me just cover one US index and then we look at, I was going to say gold and silver. We did look at gold and silver. So yeah, let's just look at a few indices, a few other indices. And then if you have any questions, we'll be more than happy to answer your questions. If not, then we'll end the webinar. So I'm starting off with the S&P 500. I keep moving this thing higher and higher. This is all-time high, right? So this is the most recent all-time high. We are very close to it. No reason why it can't break through that. Absolutely no reason. The market is obviously very overbought, but it's a very strong trend. I wouldn't advise anyone fighting this trend. It's a buy the dip market, right, Victor?
Yeah.
Until the chart tells you otherwise.
For quite a while, while it's choppy on the upside, like we haven't seen many days that, at least in the S&P 500, the more violent bullish days were on the NASDAQ over recent sessions.
Yeah.
And even yesterday when the German DAX lost 1.5% at one point, the Nasdaq was still in positive territory, and it continues to be totally decoupled. I think that the expectations for resumption of so-called normal economic activity and this rotation from tech stocks into growth stocks into value has actually paused at this point in time. And tech is once again leading the way.
Yeah, absolutely.
If you scroll over to the Nasdaq, yeah, we can see that the pace to the upside of the Nasdaq is, unprecedented in recent history, and very reminiscent of the dot-com bubble.
Yeah, absolutely. It's really difficult to trade this in a way, because on the one hand it's still bullish. You could close your eyes and press the buy button.
Yes.
On the other hand, you would think, oh, it's so overbought right here. If I buy it, that it's gonna turn lower and stop me out, because it can't go on like this.
Well, the other part is that usually moves to the downside are much more violent than to the
absolutely
upside.
Yeah. So it's difficult to say. Actually, from a short-term trading point of view, with sound risk management, absolutely you should be looking for long setups. But if you're one of those traders that look for long-term swing trades, when it's already breaking out, it's too late to get on board, in my view. Which is why I think it's better to concentrate on a European index, for example, the FTSE, because it has pulled back and it's about to stage a potential breakout. Rather than Nasdaq. But yeah, it really does depend on the type of trader you are. But,
the UK index, as you mentioned, is primarily comprised of value stocks, and recent complications around the vaccine rollout are not really helping those stocks at the moment.
No, absolutely not. So that's it, guys. If you have any questions, please ask us. I can't see any questions myself. Can you, Victor? Can you see any questions?
No, not really.
No, are you sure?
I hope that we have covered most of what you guys are interested in.
Yeah.
And we're looking forward to share some more insights next week. Absolutely.
So join us at the same time next week. And for those of you guys who couldn't make it to this webinar, and you're probably watching this on YouTube, it's better to come and watch it live, because you will have a chance to ask us questions on any market that you trade. And we would be more than happy to provide live analysis for you. This is what it's about, this webinar. It's live market analysis. So I encourage you that if you're watching this on YouTube, that you can join us next week, Tuesday, same time, 11:30 London time. We look forward to seeing you there, okay? Anyway, take care. Have a wonderful week ahead.
Take care. Bye-bye.